Hello, and welcome friends from across the globe to our most recent session of the Wharton Ready Livecast series. In this series, we bring you the very best of Wharton faculty research and insights to help us move forward considering issues confronting us, including political and strategic issues. It is my pleasure to be with you today. I'm Sue Wharton, and I lead the team that works with clients on our tailored business portfolio. It is my pleasure to introduce Peter Conti-Brown, speaking on the relevant topic of the Federal Reserve in the era of COVID-19. Peter's extensive research on central banking, fiscal crises, and the Federal Reserve will show throughout the livecast today. For those of you new to this series, I would like to direct your attention to a few housekeeping items. Peter will pause during his remarks for Q&A. Our moderator, Ed Siri, will compile questions and pass for answering. Please type in the Q&A box. If you are experiencing any technical issues, please access the moderator box and type them in the moderator box. We will have a team that will be able to assist you with those issues. Thank you again for joining us today. Peter, it is my pleasure and honor to turn the controls over to you.
Thanks so much, Sue, and thank you to everyone who is joining us in these creative and unusual times. The topic today, of course, is the Federal Reserve in a time of COVID. And the aim of this presentation is very briefly to give you an overview of just how much has changed in the last 6 months, what the Federal Reserve has done to step into the breach, macroeconomic crisis that's associated with the public health crisis of COVID-19, and to think together about what that means for the future. I'll stop after about 20 minutes or 22 minutes, and I'm happy to take any of your questions on these topics. So first, let's remember back to a different era. The sun is shining on the Federal Reserve. That's building here, the Eccles Building on Constitution Avenue in Washington, D.C. We had seen since 2009 and the recession's end that had begun in 2007, the longest expansion in U.S. history by many metrics from 2009 to 2020. In January 2020, so just 6 months ago, here is what the central bankers themselves expected for the federal funds rate. Now keep in mind, at the end of 2019, we were seeing that federal funds rate. This is the FOMC's key policy rate, about 1.6%. And they anticipated over the course of 2 years a period of normalizing that rate up to and above 2%. It's still below its historical average of around 4%, but still times looked like they were going on the track to normal. Now here it is in June. There's really no reason for us to separate the black line from the blue line. The federal funds rate is at 0. And again, this is from the same report. The central bankers themselves do not anticipate interest rates elevating from that 0 lower bound in the foreseeable future. And Chairman Jay Powell's words, we're not even thinking about raising rates. All right, well, let's look at January from the perspective of economic projections of GDP. This is real gross domestic product growth. Had a brisk year in 2019, 2% for an economy of the size of the United States. That indeed is a growth-oriented climate. They anticipated a slowdown of just a few basis points. This looks like a steep decline, but look on the y-axis on the left. We're seeing that in January 2020, they anticipated just a modest decrease and a stabilization around 1.9%. Now check out this extremely strange chart from June 2020, the last time we have these projections. They anticipate that in 2020 that we had the deepest cliff we have seen since the 19th century, with a collapse in gross domestic product, approaching 7%. And then over the course of 2020, see cross again into positive space and a rebound of 5% by the end of 2022 at 3%. This is essentially the central bankers announcing that they expect and hope for a V-shaped recovery. And again, this is in June 2020, which we sometimes talk about measuring things in dog years. Let's measure things in COVID years, where each day represents a decade of new information. So again, this is the projection that had been stabilizing around 1.9%, and we see now just how much COVID has changed there. Last one, this is on inflation. Back again in January 2020. In some context here, in 2012, the Federal Reserve decided to follow many other central banks throughout the world by announcing an inflation target of 2%. At the time, they presented that more or less as a symmetric inflation target, meaning that they would when they undershot the target, they would feel comfortable overshooting it so that it could, on average, balance the inflation target. But in the post-2008 era, the Fed never hit its target consistently, raising questions about whether this was an asymmetric target. And they said, well, in January, they thought, you know what, we're finally going to do it. Toward the end of 2020, we're going to finally hit our target, and we're going to be comfortable going above it. Whereas inflation today, well, much less. Right now, we're measuring inflation below 1%, which is because of the difficulties in measuring inflation, represents real risks of disinflation, well, certainly disinflation realized, but also perhaps deflation. And then once again, by the end of 2022, still not seeing the target of 2% hit. All right, so I want to show you a few forecasts around the world, again, comparing January to now. We see from the Morgan Stanley forecast at the end of 2019, global growth at about 3%, US at 2.3%. 2020, 2021, good for the world, and just a slight decrease in the US, consistent with the official forecasts. Now here we are in June. Global 2019 growth at 3%, global -3%, and then an offshoot of about 6%. This is again the anticipation of a V-shaped recovery over the course of a year, the US looking similar. So I show you that contrast because what a contrast it is. In January, folks like me who watch the Fed closely were very worried about disturbances in repo markets, whether or not the primary dealers were funding themselves precariously and the Fed's interventions in that regard. We were worried about inverted yield curves, at a time when investors are anxious about long-term growth prospects on long-term assets and predicting whether this would be a recession coming. But we also saw asset prices in equity markets reaching record highs again and again. And then COVID-19, this great meteor, slams into the global macroeconomy, and this causes the Fed to act. I'm not going to go through each one of these, but I just want to show you the breadth and scope of what the Fed has been about since March 2020. The federal funds rate goes to 0. Forward guidance is announced. That's central banking speak saying what I said earlier, that they are going to keep those rates very low for a very long time. We get securities purchases. The Fed's language for this is a large-scale asset purchase. A lot of everybody else calls it quantitative easing, or QE. Initially, it was restricted. We're going to buy so many tens of billions of dollars in assets. Now it is unlimited. Started lending to securities firms very actively, using the Fed's emergency lending authority under Section 13(3), which requires unusual and exigent circumstances, coordination with the U.S. Treasury, and a significant support for sectors and facilities as opposed to targeted firms. We see backstopping of money market mutual funds, which are outside of banks' traditional regulatory and the Fed's traditional bank regulatory and supervisory authority. Repo operations that I mentioned earlier, support for those ramped up significantly. Direct lending to banks. This is about the only element on this list that comes through the Fed's non-emergency authority. Temporarily relaxing regulatory requirements, direct lending to major corporate employers, which is a very different ballgame than the Fed is used to. A commercial paper funding facility, supporting loans to small and mid-sized businesses, term asset-backed securities loan facility, direct lending to state and municipal governments, which is again a line that even in 2008 the Fed did not cross, supporting municipal bond liquidity, international swap lines, and even if countries don't qualify for those swap lines, creating a new facility that essentially accomplishes the same thing. I want you to ponder that list. So I know a lot of you, maybe your eyes turned to marbles a little bit as I went through all of that. Some of you live and die by some of these programs right now in your work. But the point is the Federal Reserve is attacking the macroeconomic consequences of the public health crisis in a way that it has never done for financial crises before. What became normalized in 2008 with the invocation of emergency lending authority started as the baseline. Unconventional monetary policy and emergency lending policy in 2008 became the first tools used, the first levers pulled. What is now unconventional, direct lending to corporations, small businesses, or lending through banks to small businesses, supporting state and municipal bond markets. These things represent a brave new world of central bank policy. Now, because something is new doesn't make it bad, but it does make it unusual, or even better, unprecedented. And so we are in a place where the Fed is doing things that we have never seen before. This is slightly dated from May aspect. These are in billions of dollars. How much authorized, how much outstanding. The Main Street Lending Program is now open. We'll be watching extremely closely, of course, to see how much take-up there is from that program. What does this mean? I love this picture. I'm going to get so much mileage out of this picture. The elbow bump behind masks between the Fed chair and the U.S. Secretary of the Treasury. Historically, we have thought about the central bank's institutional insulation from politics as being its most essential feature. In the COVID crisis, to a lesser extent the 2008 crisis, we see that rather than having an insulation from Treasury influence, we're seeing a dramatic partnership. Now, this partnership is not happening in the shadows. Not only are these two elbows bumping right in front of the cameras, but Congress, in the passage of the CARES Act in March 2020, said to the Fed and Treasury's relationship, we're betting on the Fed. Now, there are, of course, programs that were administered through the Treasury. PPP is a major one. Unemployment insurance adjustments is another. But the Congress created also a $454 billion fund that requires the Treasury, so this is $454 billion appropriated to the Treasury, rather than telling the Treasury, go and spend this in a way that will support the economy, Congress said to Treasury, go invest this in the Federal Reserve. Let them take the lead on the crisis response. This raises some important questions about what the proper role for a central bank responding not just to macroeconomic crises in general, but to this macroeconomic crisis in particular, should really be. Those of you watching who have lost your jobs and or who own small or medium-sized businesses are wondering how on earth you can maintain payroll in the face of so much uncertainty, might look at some of these facilities that I just mentioned here and think, that's all fine and good, but I don't need more debt. More debt is not the thing that will help me survive. What will help me survive is a return to normalcy, so I can fund myself through traditional means of retained earnings or perhaps the capital markets, or B, barring that, and given the significant uncertainty with spikes in COVID infections and the potential for a second wave before the first is even broken would be grants. In other words, if this truly is something where we are all in this together and we want to keep as many viable businesses going, as many families, households, individuals engage as productively as possible when we are simultaneously telling them to close their doors and stay inside, is Fed lending the right policy tool? Now, obviously, the way I framed that question suggests that I'm skeptical that it is, but that is exactly, by dollar amounts, exactly what the government's response has been, that we're going to accomplish these goals through the Fed's balance sheet. And for very good policy, and I will say legal reasons, the Fed doesn't make grants. It makes loans. Of course, it can lose money on those loans, but it has to make loans. And so that presents a real problem. And Congress, for all kinds of political reasons that I can address in the Q&A, prefers the process of having this delegation to the Fed, largely for political reasons, bipartisan political reasons, I will say. It insulates it doesn't insulate the Fed from politics. It insulates politics from the Fed, and they like this. And so that represents real tension, thinking about the policy responses that will come in the weeks and months ahead. So what does this all mean in addition to the weakness here? Well, in 1951, there's a very famous instance in central banking history called the Fed Treasury Accord. It was a very dramatic moment where the FOMC met in the Oval Office with Harry Truman. They accused each other of all kinds of bad things, and it was in the newspapers. And Truman essentially called all of the central bankers communists. He didn't essentially, he really did, because they wanted to pursue an anti-inflation policy at the very beginning of what would become the Korean War. In March 1951, they struck a deal that basically liberated the Fed to pursue its own policies while recognizing the crucial role the Fed plays in supporting Treasury markets. And that understanding has basically been the tradition with only a few exceptions. One was Richard Nixon's relationship to his Federal Reserve. A second is Donald Trump's relationship to his. The idea that the Fed stands strong against political pressures has again been part of its DNA. Will it still? Will the fact that we've got these elbow bumpers working together so closely, is that the new normal? And if so, what does that mean? What does it mean for interest rates? Well, if your business model depends on interest rates at the Federal Reserve launching from the zero lower bound anytime soon, my advice to you is to find a new business model, because there the interest rates are likely to stay for a very long time to come. The third thing to think about are the false dawns. I put that in quote. In the Hoover administration from 1929 to 1933, there were a series of moments that captured the national attention whereby the president and many in the public, business leaders, felt that the Depression had finally been licked, that it was over. By my count, there were about 7 of these major moments. And I don't just mean a speech where he said, I think it's behind us. I mean editorials, a big moment where some evidence would be taken to say the worst is behind us. And I think that the COVID-19 public health crisis, and by direct correlation, the macroeconomic crisis, is very much subject to these same kinds of false dawns. And that means that overenthusiasm on minimal good news is very possible. Indeed, I think should be expected. COVID-19 is here with us and will be for a long time. And what we don't know, I of course am no epidemiologist. I know what you know about masks and social distancing and vaccines and all the rest. But I do know that the Fed is going to be deeply invested in every bit of evidence that the public health response has finally succeeded in subduing the crisis. Well, I want to make some time for you, so I'll just skip these last questions about inflation and asset prices and open the floor now to our moderator to introduce some questions.
Great. Thank you, Peter. And on behalf of the moderator team, thank you for submitting your questions. We do have some time here, so feel free to keep using the Q&A to submit those questions. Now, Peter, speaking of inflation, there actually was a question about inflation. So how are you thinking about inflation in the short and long term? Do you think there'll be a slight increase in inflation or a risk of hyperinflation? And do you think the Fed will respond, and how do you think they will respond?
Such a great question. If you'd asked me this 10 years ago, I would give you a textbook answer, which would be that the Federal Reserve's balance sheet in 2007 was less than $1 trillion. After 2008, the balance sheet, these are just assets, after the 2008 crisis, that balance sheet ballooned by a half order of magnitude to $4.5 trillion. I didn't check this morning, but I think the balance sheet is around $7.5 trillion today, and is anticipated to go up to 8, 9, maybe $10 trillion. But what does that mean? Well, and again, the textbook answer is that amount of assets, when the Fed issues money as it has done on its liability side, suggests that in an absence of increased productivity in the economy, that's going to get digested by the economy through increased inflation. Now, the reason I am not as confident in that answer now, and indeed I'm quite skeptical of it, is it was precisely that claim in 2009 that people said a tsunami of inflation is coming. And the Fed never succeeded in raising inflation, despite its efforts, above 2%. So what the central bankers are doing now throughout the world, and not just in the United States, is bringing their model, the model I just introduced to you, which is very familiar to all of us, about what inflation is and where it comes from, for re-examination. There is always a chance that inflation will be the mechanism through which the economy digests this amount of money expansion. The question becomes, how will that occur and when? And right now, even our best models of inflation are not very good at answering the question. And focusing on inflation where there is no inflation to be seen in the short run can have the effect of dramatically, can have the effect of making policy responses today much worse. And so what the Fed has to do, what Congress has to do, is navigate the situation we are in and then strengthen the Federal Reserve to help understand and manage what the consequences will be down the road. So I think to sum up, my answer to that is now is not the time to be worried about inflation, but in the medium term, maybe a time to worry about inflation. And it won't be too late to worry about inflation once we are through the current crisis, because we do have lots of tools that we already know about and tools that have not yet been designed that'll help us navigate exactly that problem.
Thank you, Peter. So a lot of people are wondering about an additional stimulus package, perhaps maybe in July. I know there's been some talk about it. Do you have any thoughts about that down the road?
I know that it's not unprecedented for the Federal Reserve Chair to needle Congress into doing more in the fiscal space. We've seen it several times throughout history. This was, in fact, something that Alan Greenspan did quite often, is engage in fiscal policy commentary. But we are seeing Jay Powell do exactly that in his polite way, saying that the Congress should do more with fiscal policy. Is the equivalent of a central banker lighting his hair on fire, running into the Capitol saying, you must focus on fiscal policy and you must do it right away. So I saw Mitch McConnell yesterday saying that he anticipated another stimulus package coming, another I would call it a COVID relief package. It's going to take a variety of forms. I think the thing I would watch for most, certainly as a Fed watcher, but also as a constituent, also as someone who's encountered difficulties, of course, through the COVID-19 period, is I sure hope that Congress has not overlearned the lesson of how effective the Fed is. Because the Fed's tools are so limited that we're seeing spectacular support for capital markets, spectacular support for asset prices and liquidity in the financial system, but not the kind of support that is needed when a masseuse making $60,000 a year with good business and good skills who is forbidden from engaging in his or her work needs to be able to bridge the gap until this is over. Taking out a loan may not be something that's going to help that particular person. So whatever the politics around this, and I recognize, of course, that there's partisan content in this. Republicans and Democrats are going to disagree about things major and minor. I hope that Congress recognizes the institutional prerogative that it has a role to play beyond simply delegating to the Fed to make more of these decisions. The Federal is vital, and it is showing no sign of losing its appetite for experimentation. I hope the same can be said of Congress as they're confronting these problems with the policy tools that they uniquely hold, which is the fiscal policy tools.
Thank you, Peter. So the talk of inflation has sparked the opposite, deflation. People are wondering, do you see any chances of deflation happening, and what would the drivers be?
Absolutely. It's always, when we're talking about general price levels for a global reserve currency like the dollar, it's always dangerous to reason from anecdote. So I'd warn our viewers against that kind of thing when you watch gas prices falling, saying, okay, well, this is certainly deflation. Just as when you see the price of toilet paper exploding, that's not necessarily a sign of inflation. So we have these metrics to try and account for this. Some metrics take energy prices, because they're so volatile, out in order to assess this more consistently. But what we're seeing right now is inflation below 1%. And when we get to inflation below 1%, we really risk measurement error, missing the fact that we are indeed in a deflationary environment. Now, for some folks who've got a lot of student, if you are positioned in such a way that your assets, the value of them, deflates, right? That can be quite devastating. For some, on the opposite end, if you were a lender, then having a deflationary environment makes the loans made in the non-deflationary environment much more valuable. And so, as with the case with currency exchange and trade risks, inflation and deflation affects different households and businesses in different ways. But from a macroeconomic perspective, deflation is devastating. Deflation pulls all those who rely on debt financing to expand their business, to go to college, to buy a home, puts them in a position where they cannot escape. And that creates an overhang problem where they can't be a part of the solution of reviving our economy. And so inflation is problematic as well. Anyone who's seen inflation eat away at their nest egg out or near retirement, for example, knows the sensation. Those who survived the 1970s and remember sky-high interest rates with a 20 handle, for example, not something that we have seen since then, can empathize with this view. But the difference between inflation and deflation for the entire macroeconomy is not symmetric. Deflation is much, much worse. That's one reason why, as we see interest rates at this level and inflation rates at this level, we can know that we are in quite dire circumstances and need the Fed's monetary policy especially to do as much as it can to lift inflation above where a measurement error might in fact be indicating deflation.
Thank you, Peter. And again, thank you to everyone who submitted a question. Peter, thank you for taking the time to answer the question. I will turn it back over to you for any final thoughts or any messages you want to deliver as your parting words here as we come up on the end of the session here.
I think I'd give you two parting thoughts. Number one is I'll make it as business oriented as possible. I hope this doesn't offend anyone who was thinking about this from purely a policy perspective. But forget the PPP shaming that you might have seen in the news. This business got a forgivable loan from the Small Business Administration, that one did, etc. What if you are in a situation where you can take advantage of the Fed or Treasury's programs in response to COVID-19, you should absolutely do it. And this is not just self-interest, it's for the better of the economy. If people are using these policies and putting their money to use whether that's through expanding their balance sheet or retaining their payroll for a forgivable loan, the follow-on effects for this are substantial. So I'm a big skeptic of those who are very angry that Shake Shack might have taken money from the PPP. Reality is Shake Shack has employees too, and what we want to see is an economy primed, ready, rip-roaring to go when vaccine or change in policy or change in behavior puts this awful nightmare behind us. So that's number one. Get smart about these programs. Learn about the ones that are relevant to you and your businesses, and take advantage of them to the fullest extent that you can. The second is, from a policy and citizenry perspective, remember that what happens with the Federal Reserve, probably more than any other institution, and I would include the Supreme Court in that analysis, affects your life. Inform yourselves about it. Stay up to date on this. When the president nominates new central bankers, this president or the next president, whenever that may be, become aware of who these central bankers are. In the same way that you might have followed the Brett Kavanaugh hearings, you should follow Fed governor hearings as well, because the Federal Reserve is such a vital institution, but it's an institution that belongs to all of us. My neighbor said to me the other day, he asked, are we a nation with a central bank or a central bank with a nation? And the answer is we are a nation with a central bank. That we need to keep an engaged citizenry who's focused on these issues, mindful of them, and engaged on them. And that's all I have. Thank you so much for your attention, and I hope this has been useful to you.
Thank you, Peter, for this impactful session and the deep discussion on the impact of the Federal Reserve. Fed's balance sheet discussion and congressional navigation was quite enlightening, and the call to awareness is always key. As a reminder, please check the Wharton Executive Education website for the upcoming schedule of Wharton Ready sessions. And finally, if what you have heard is something you want to bring to your organization or explore bringing to your organization, visit our website or reach out to anyone on the Wharton team. We look forward to working with you. Please enjoy the rest of your evening or day, and thanks so much for being with us. Take care. Bye.